we are in such interesting times, to say the least. I mean, I haven't looked at my phone in an hour, but I'm sure something has changed. I think what will shape us, and this may seem a little cliche at the end of the day, is how we work together. Because we have no choice but to go forward. So we can be thrown a lot of noise, but it's for us to determine how we best address those noise and how we best move these projects forward. So I think, this business always comes down to relationships, and I think how we work together to move our industry forward is really what's going to shape us in the next year ahead.
Resilience. I think, I'd be lying if I knew what was going to happen in the next little while, but at the end of the day, our industry is cyclical, and a lot of people here have seen many cycles, and this is just one of them.
So I think the industry in the next 12 months will be heavily influenced by uncertainty, if that makes any sense. So I think what we're going to see here is that it's going to be difficult to do some of the things that we want to do, some of the things that our clients want to do. So I think what's going to have a big impact is navigating that uncertainty, putting plans in place that are flexible, that can survive, an uncertain climate. And I believe we'll enter a more stabilized period, in the near future. But how we get from here to there, I think, is really going to have a big impact on the market this year.
Yeah, the industry across the next 12 months, the easy answer to that is all this tariff turmoil. It's something that it seems like it could be easy to solve. Perhaps there's some sort of deal that gets reached, but the damage is already done because there's already uncertainty. The supply chain is a long and complicated beast. If there's some economic weakness right now, it's not going to show up in the supply chain for months and months into the future. Tenant demand may continue for months into the future as well, for things like the logistics space, because it just takes a long time for that to turn around. And so my concern is that maybe we've already started to experience a shock. We haven't even known it yet, because the behavior of all these individuals at small companies and importers and exporters, they're already starting to face some price changes, but it's taken a long time for that to kind of trickle through to every little bit of the economy. And a lot of it's kind of unpredictable. You just don't know. There's such a vast array of goods and services sold in the economy and how it's all priced and where it all comes from. It's not a simple look at 3 columns in a spreadsheet and think about how every piece comes together. There's a wide variety of goods sold everywhere, and it may take a long time for us to see the effects of even the fear that we've had recently. If some grand bargain happens tomorrow, it still might be too late. So that's the near-term thing I'm worried about. But then the longer-term thing that I'm looking at to think about performance is the generation of income and how do you continue to develop that for a property. We are at a different time in commercial real estate today than in all of my career and in the career of many of the people who are here at the conference. If we go back to the mid-1980s, interest rates worldwide were at record highs because of the high pace of inflation we had in that period of time. Everyone here, their careers have been built on a period when interest rates were falling. On average, in the United States and Canada, assets are held for about 7 years before they're sold. So what that means is every asset bought from around 1985 up until, and that's when I graduated high school, so I wasn't working then, but I look at data, so I know data. From 1985 up until 2020, anytime a building was sold, the person who was selling it to a buyer who was in a lower interest rate environment than when they bought it originally. So that generally means that cap rates were falling over the 7-year period. Now, cap rates and interest rates, they don't move one-to-one, but they rhyme at some point. But then also, the cost of financing was lower along the way. So there was always that next person you could sell it to who could pay a lower cap rate. You could have a person mismanage an asset, lease it improperly, spend too much on CapEx, and still somehow be able to eke out a return on the property just because of the cap rate compression. That game is over, unless we suddenly go back down to sub 1% 10-year treasury. And part of the issue is everything bought since 2007 has been done in an interest rate that was lower than we are today. Let's say we stay flat at the current interest rate levels for the next 10 years. That's like a best case scenario. Even if we have that, every deal that comes up, capital market forces are going to be headwind as opposed to a tailwind. And so with that as an issue, the way to really drive money is to go old school in real estate, to focus on the fundamentals. It's not about hitting home runs, it's about hitting singles and doubles, managing your CapEx spend properly. Don't get too far ahead of everybody else in CapEx in the market. Focusing on leasing, keeping your tenants in place, and managing all that effectively. So it'll be much more of a fundamentals and management game over the next 10 years than it has been since the 1980s. And this is a different environment than everybody here at the Forum has been working in their careers, except for a few folks who were around in the early 70s. There's not too many of those left, but if you ever get a chance, you sit down with them for a cup of coffee or a drink, then ask some stories about the old days, because I guarantee you'll learn something.
That's a really good question, and I'm not sure I have the answer to that, but I think with cautious investments moving forward and perhaps interest rates stabilizing, that will be the precursor to growth.
Across the next 12 months, I think we're going to see uncertainty in the market, of course, but Indigenous communities aren't as affected by short-term volatility, because there's a long-term lens through which projects are viewed and community development is looked at. It's not as acute an issue around shorter-term volatility. There's a really important movement here around self-determination and understanding the why of why these projects are important to communities. It's part of their inclusion in the economy. It's part of giving their identity and culture a voice. It's part of creating economic reconciliation, jobs, procurement, training, and capacity building. That's a movement that is much bigger than 12 months, and it's really going to happen over the next decades and generations in a really exciting way. And British Columbia is really well positioned for that with our rights and titles, the location of Indigenous lands relative to urban centers. You're seeing a lot of really innovative and exciting land use planning happening in our region, and it's really becoming a role model for the rest of Canada to follow. And I've traveled across the country, and people look at what nations are doing here in British Columbia with inspiration, and it really is time for the Indigenous economy within the country.